As the mid-2026 trading sessions churn through another wave of speculative rotation, Nuburu Inc., traded on the OTC market under the ticker BURU, hovering near $0.17 to $0.18 per share, finds itself trapped in one of the most intriguing structural paradoxes of the modern microcap universe. If you glance at standard financial media feeds, retail-focused chat rooms on Discord, or algorithmic stock scanners, Nuburu is frequently dismissed as a distressed penny stock, a victim of severe exchange compliance pressures, tight cash preservation metrics, and a history of heavy capital burn. Yet this superficial consensus entirely misses the radical physics and strategic pivot happening beneath the corporate hood. While retail traders cycle through high-beta momentum plays and mainstream analysts write off small-cap hardware innovators due to near-term liquidity strains, institutional architects and strategic partners are watching a fundamental transformation: Nuburu's aggressive evolution from a niche industrial blue laser manufacturer into a next-generation dual-use defense and security integrated platform. The core market mispricing here is profound. Wall Street's short-term models price Nuburu strictly on its legacy industrial laser revenue trailing indicators and immediate balance sheet stress, completely overlooking the unyielding physics bottleneck of modern advanced manufacturing, high-density electronics, and directed energy defense applications where traditional infrared lasers fundamentally fail. To understand why this disconnect exists, you have to look past the ticker tape and examine the literal laws of physics governing how light interacts with highly reflective metals. For decades, industrial manufacturing relied on infrared lasers, wavelengths sitting around 1070 nanometers, to weld and cut metals. But physics imposes a brutal penalty when you point an infrared laser at copper, aluminum, or gold. These materials reflect up to 90% of infrared light at room temperature. The result is massive thermal scattering, unstable weld pools, microscopic porosity, and structural defects that plague everything from electric vehicle battery packs to next-generation aerospace components. Enter Nuburu's proprietary high-power blue laser technology. Operating in the blue spectrum, around 450 nanometers, these materials absorb blue light up to 20 times more efficiently than infrared wavelengths. This is not merely an incremental upgrade, it is a fundamental physics breakthrough that allows for spatter-free, defect-free, high-speed welding of critical transition metals. In the realm of advanced electronics and e-mobility, where battery cell interconnects must be flawless to prevent catastrophic thermal runaway, the blue laser is not just a tool, it is an absolute gatekeeper technology. Yet retail investors staring at daily red candles and fractional stock prices fail to appreciate that mastering blue laser physics requires years of deep semiconductor material science, actively aligned micro-optics, and high-brightness diode engineering that cannot be easily replicated by a well-funded competitor overnight. This technical moat stands in sharp contrast to the brutal market dynamics and institutional positioning playing out in the daily trading volumes of BURU. Microcap equities operating through transitional phases are classic battlegrounds for liquidity squeezes. With the company's recent navigation of exchange listing requirements, transitioning its trading venue while pursuing structured appeals, executing equity restructuring, and managing a massive pivot toward defense-oriented consolidation, the stock has experienced intense downward volatility. Retail sentiment has been repeatedly shaken out by dilution fears, negative net income prints, and the psychological toll of holding a low-priced asset during a broader macro rotation away from speculative microcaps. Yet seasoned market insiders recognize that institutional accumulation in microcap turnaround stories rarely looks clean. Heavyweights and strategic debt holders don't buy into companies when the narrative is comfortable. They step in during periods of maximum pessimism, restructuring debt obligations, backstopping capital raises, and positioning themselves for multi-year catalysts. While retail forums chatter about short-term price fluctuations and support levels at 17 cents, Smart Capital is underwriting the structural value of a newly fortified balance sheet, which saw stockholders' equity swing dramatically into positive territory following recent capital market actions and strategic asset integrations. Before you dismiss this as just another speculative gamble, let me ask you directly. How many of you actively scan the microcap and small-cap hardware sectors looking for deep value physics plays, or do you find yourselves paralyzed by the short-term volatility and delisting headlines that routinely shake out retail investors from asymmetric opportunities? Drop your thoughts in the comments below. To truly grasp where Nuburu is heading, we must deconstruct its business model and historical context, separating the outdated framing from the modern growth reality. For years, the market boxed Nuburu into a narrow box, a cyclical industrial equipment supplier selling high-power blue lasers to automotive assembly lines and consumer electronics factories. In that legacy framing, the company was entirely beholden to macro capital expenditure cycles. When automotive manufacturers delayed factory retooling or consumer electronics demand softened, Nuburu's commercial revenue lagged, resulting in constrained cash flows and an over-reliance on a nascent commercial market that was slow to adopt novel optical solutions at scale. But framing Nuburu solely through its historical commercial laser lens is akin to evaluating Apple based on its early days as a desktop computer hobbyist shop. Over the past year, management has executed a radical strategic expansion, transforming Nuburu into a next-generation dual-use defense and security integrated platform company. This operational evolution merges its world-class proprietary laser capabilities with software-orchestrated protection systems, electronic warfare capabilities, advanced mobility frameworks, and strategic international acquisitions like its positioning around Techne SPA and other specialized defense infrastructure assets. This pivot into the defense and security landscape fundamentally alters Nuburu's addressable market and financial profile. Modern military and critical infrastructure markets are facing an unprecedented technological shift. The proliferation of low-cost aerial, land, and maritime drones, along with first-person view threats, has rendered traditional kinetic defense mechanisms economically unsustainable. Firing a multi-million-dollar missile at a multi-thousand-dollar drone is a mathematical dead end. This is where directed energy and non-kinetic effects systems come into play. Nuburu's integrated platform now encompasses proprietary blue laser dazzlers for sensor denial, soft-kill laser non-kinetic neutralization, counter-drone architectures, and ruggedized in-field mobile production systems optimized for stringent compliance standards like ITAR, EAAR, CFI-US, and NATO frameworks. By combining high-power laser physics with software-assisted command and control analytics, Nuburu is no longer just selling a tool to weld copper vehicle batteries. It is embedding itself into sovereign defense supply chains, where multi-year procurement budgets dwarf commercial industrial equipment spending. Looking toward the future outlook, catalysts, and structural risks, the narrative shifts from past operational hurdles to execution milestones. The multi-year growth thesis for Nuburu rests on its ability to convert its expanding pipeline of defense and industrial opportunities into firm contractual orders throughout 2026 and beyond. On the technological front, the company remains a gatekeeper in high-brightness blue laser engineering, a capability that holds immense value not only for defense non-kinetic countermeasures, but also for the booming global electric vehicle and energy storage manufacturing sectors as they demand higher precision and zero-defect copper welding. Furthermore, the strategic integration of international defense assets, backed by recent capital raises and significant debt extinguishments that repaired the stockholders' equity deficit, provides the structural foundation required to bid on major government and defense prime contracts. However, any objective analysis must weigh these explosive upside catalysts against very real operational and financial risks. Nuburu remains a high-risk, high-reward small-cap entity. Despite recent balance sheet improvements, operating cash flows remain negative, and the company must successfully scale its commercial and defense revenue streams to achieve long-term financial self-sustainability without continuous reliance on equity markets. The transition from exchange listings to the OTC market, combined with the necessity of executing corporate actions like planned reverse stock splits to regain institutional compliance and investor accessibility, introduces friction that can deter conservative capital. Geopolitical regulatory hurdles, international defense compliance clearances such as foreign direct investment and golden power regulations, and the inherent lumpiness of defense procurement cycles means that quarterly revenue realizations can be volatile and difficult to predict. Yet this is precisely why looking past short-term noise matters for the sophisticated investor. The financial media and day trading crowds are perpetually trapped in the immediate emotion of the daily ticker, reacting to fractional price ticks and exchange notices